Okay, hello and welcome to all our attendees for today's webinar. We have all of our speakers on the line and a good number of attendees who've connected so far. This webinar is hosted by the GSMA Mobile for Development Utilities Program. And this is the first in a three-part Investor Roundtable series. Today, our focus will be on investments made by foundations, and this session will last for about an hour. My name is Wade Owajori. I work on the Empathy Utilities Program, and I have the privilege of moderating today's webinar. I'll be supported by my colleague Charu Chadha, who will be collecting questions from the audience. We're joined by three great speakers. We have Erin Crosset from USAID Development Innovation Ventures, Charlotte Ward from the Lundin Foundation, and Josephine Ragney from the Netri Foundation. A warm welcome to you all, and very great to have you with us. We'll come back for an introduction of each of our speakers in a short while, but before that, let's take a look at what we plan to cover in today's session. In a moment, I'll give an introduction on the GSMA Empathy Utilities Program. After that, we'll hear from each of our speakers, and they each in turn will give us some background into their respective organizations, some insights into their investment mandate, how they find deals and what they look for, their investment process, and we'll get their advice on best practice and what things to avoid. There will be time for Q&A. We'll take that at the end. And for all of our attendees, you can submit your questions at any stage via the chat box. And please direct your questions to staff. We also have a great pool of questions which were submitted during the registration, and we'll address as many of those questions that have not already been covered by today's presentation. At the end of the series, we'll be publishing the frequently asked questions on our website. This webinar and all subsequent sessions will be recorded and made available on our website. Now we can get into the content. And I'll start by saying a few words about us. Empathy Utilities is a program within the Mobile for Development group at the GSMA. The GSMA is a global association for the mobile industry worldwide, representing interests of nearly 800 mobile operators and almost 300 companies in the broader mobile ecosystem. The Mobile for Development Group works in partnership with the UK government's Department for International Development. And our focus on the Empathy Utilities program is to cover the basic utilities, which is energy, water, and sanitation services that leverage mobile to reach underserved communities in emerging markets, as illustrated by our mission statement. A look into our program activities, and some examples here include our grantee case studies and thematic insight reports that we share and publish, and a number of working group events that we convene. As part of our advisory services is how we champion the cause and identify opportunities in the utility space for our mobile operator members through things like our feasibility studies. I have a slide dedicated to the Innovation Fund, which we'll come to. And under market building, we have activities to facilitate further investment and crowding in. This infographic illustrates the program's impact since 2013 and is taken from our most recent annual report, which you can download at gsma.com/mobile for development. Through our Innovation Fund, we have been able to positively impact nearly 2 million direct beneficiaries. This is a nice segue into our fund, which is funded by the UK government for the UK government's Department for International Development. We have run 2 phases. And we plan to do a call for our third phase in 2017. In terms of the grants that we offer, there are 3 types: seed grants, which are targeted at early stage trials; utility partnership grants for partnerships between utility companies and service providers; and market validation grants for scaling and replication of business models. Here you can see the regions in which we cover and some examples of grantees that we have worked with and continue to work with. Now, to talk to us about our grants and the program, I will actually switch to telling you about why we're hosting this webinar today. Now, we've seen that there has been quite a bit of challenge for entrepreneurs using mobile technology, particularly for energy, water, and sanitation services, even though in recent times we've seen an increase in the investments going into pay-as-you-go solar, for example. There's still a lot more work that can be done. And so this series has been convened to help give entrepreneurs guidance on developing a better understanding of the types of investments, types of investors, and how best to engage with investors when raising funds. And so to lead us in that discussion, I can now hand over to our first speaker, Erin Crossett, who is the Portfolio Manager at USAID Development Innovation Ventures. Hi, Erin. Hi, Erin.
Hi. Can everyone hear me?
Yes, I can hear you.
Excellent. Great. Well, thank you so much, DSMA, for having us. And it's good to be here, and I look forward to telling everyone a little bit more about Development Innovation Ventures. Brief bio about myself. I am a portfolio manager with the DIB team. I've been on the team since about April, prior to which I was working on, my background is in impact evaluation, so I was working on a couple of randomized control trials in the water and sanitation space. So just diving right in to the background slide. And what I'm just making sure is that that up as well. Excellent. Great. So DIV employs a staged funding model. And so DIV is Development Innovation Ventures has been around for about 6 years now, and we're part of the U.S. Agency for International Development. Specifically, we are housed within the Global Development Lab, which is a bureau within USAID, and we're a DC-based fund. So as I was saying, we employ a staged funding model where the size of investment is commensurate with the evidence of potential for success. So as background, DIV was co-founded by Maura O'Neill, which is a former USAID Chief Innovation Officer, and Michael Kramer, who's a leading development economist at Harvard. And so evidence of impact is one of our core competencies and something that we really prioritize in our selections process. And so DIV recognizes that organizations supported will need flexibility to sort of iterate and adapt their innovations. And so we really aim to strive to provide this flexibility in our funding. In terms of sectors, we're sector agnostic, so we work across all sectors. About 19% of our portfolio, or a quarter of our total funding, is in energy, mostly in the off-grid energy space, and 9% of our portfolio, or 16% of our total funding, is in the wash space. So as I mentioned, in terms of our stage approach, so DIV supports innovations from the proof of concept stage, which is our equivalent of our stage 1, through scale, which is our stage 3. And the two main buckets that we offer are grants within operations and research. So operations are things like market validation and determining some of the core business questions, where research grants are, as I mentioned, we actually fund randomized control trials, impact evaluations, and other ways to sort of causally determine whether or not you're basically validating your theory of change, and also determining whether your program had impact, and if so, what was the impact estimate. Also, investment size and structure. So we're exclusively grant funding. Our stage 1 ceiling is up to 150,000. Stage 2 is up to 1.5 million, and our stage 3 is up to 15 million. However, our largest grant to date was about 7.5 million. And we work anywhere where USAID operates. So that's the largest type we have are in South Asia and East Africa. So Kenya, Rwanda, Uganda, Tanzania. And we have about 80 million investments to date. And our portfolio is about $80 million to date, and then our portfolio is we've made about 160 awards total. I'm getting a little bit of feedback, so hopefully everyone can still hear me. We also provided a brief snapshot of the grantees that we're supporting. And as you can see, those represent both the off-grid energy space, the WASH space, and then organizations like IPA and Evidence Action, which are more focused on the research. Okay, so moving on to our investment mandate. So I put here DIV's mission statement. So as I mentioned, we're an open innovation fund. We source, test, and accelerate innovations that address global development challenges. And we really are looking for interventions that could, that could essentially scale to millions at a fraction of the cost of standard development practice. So in terms of our return expectation, given that we are grant funding, we have a little bit more flexibility, and we don't have specific thresholds or cutoffs for a financial return. And we really are looking for a base of the pyramid focus, and definitely having a poverty alleviation component to your model is critical to receiving DIV funds. So the return really does vary on the stage and the purpose of the grant. And we use milestones and performance-based payment to sort of incentivize performance and also manage risk on our end. We also look for, as I mentioned, social impact, and so more of a social rate of return. And so sort of one metric or one heuristic we use here is, what is the probability of success for this grant, and what is the estimated level of reach, or how essentially what is the potential for scale for this innovation. And then another core aspect that DIV really cares about is catalytic funding. And so while DIV does offer stage 1 through 3, we don't typically, only one grantee to date, Off-Grid Electric, has actually progressed through all 3 stages. And I would say that our model is not designed necessarily to go right from a stage 1 to a stage 2 to a stage 3. In fact, fewer than 10%, or around 8% of our grantees receive follow-on funding for a subsequent stage. So we really look for organizations we invest in organizations that we believe can receive funding from other sources, whether it be from their customer base or additional public investment. And so our average leverage amount is around $900,000 per grant, and so we really are looking for DIV funds to be catalytic to growth, and so a lot of that is through external finance. So the duration of investment, stage 1s are up to 3 years, and our stage 3s are up to 5 years. So I can give a brief overview of the stages before we continue. So our stage 1 testing is intended to introduce an innovation to target customers or beneficiaries in a developing country and to gain early sort of real-world assessments for the potential for technical or financial viability. And as I mentioned, the evidence of impact is really scaled to what stage you're applying for. So obviously, as you apply for stage 3, then we really look for a high, there's a high sort of burden of evidence, I would say, whereas our stage 1s are very much seen as more experimental grants and are really testing unproven ideas. Stage 2s are intended to test promising innovations that already have some proof of concept to measure social impact and cost effectiveness, or establish market viability, and also through implementation at a sufficient scale. So we can generate some more lessons to inform paths and to further scale and sustainability. So things like operational refinement, etc. And stage 3 is intended to adapt to tested and proven innovation in new contexts or geographies, and to also engage additional partners who will help scale the project beyond DIV support. So again, thinking in terms of not using DIV funding long term, but essentially leveraging DIV funding to be catalytic and to receive additional funds. But also stage 3s, need to gather additional evidence. So think something like external validity and a more established track record are needed. So to date, we've made we're about to make our 4th stage 3. So like I said, the burden of evidence there is pretty high. So moving on to the next slide, finding deals. In terms of how we scout for deals, so we have like I mentioned, we're an open innovation fund. So we are open for applications, which what we call an expression of interest, 365 days of the year. You can go to usa.gov/div, and there you can find a link to the EOI. So that can be submitted or rolling. You can apply any time of the year. There's no one time is better than another. We truly are rolling. And we also scout for deals just through strategic sourcing, through similar like-minded funders, so Gates, Global Innovation Fund, School, USAID missions essentially will refer us to organizations within their countries who are, could fit DIV's investment criteria, and conferences, so SENCALP, SOCAP, Global Entrepreneurship Summit, etc. And then the 3 things that we look for in an organization, as I mentioned, are 3 sort of core, we call them the 3 legs of the stool, are cost effectiveness. So really looking for innovations that deliver more development impact per dollar than other ways of achieving the same development goal. So something like, increase literacy per dollar compared to the existing practice. Evidence of impact. So, we really encourage the use of rigorous testing methods, whether it's something like a randomized control trial, A/B testing, variant market tests as appropriate given the stage of the proposal and the scale path. And evidence can, in our purview, can encompass ultimate impact, so something like infant mortality or improvements in implementation outcomes, so something like takeout, for those solutions that have been causally linked to ultimate impacts in the past. And then last, we have pathway to scale. And so the ultimate goal of DIV is to support solutions to scale sustainably, to reach millions within a decade. And so solutions must have a potential pathway to scale, whether that's commercially through incorporation into the practices of of developing country governments, donors or philanthropists, or through a hybrid model, a combination of commercial and public or philanthropic support. So we recognize that innovations can take a variety of scale paths, but we would expect ultimately that they would continue to grow without DIV support. And as I've mentioned, the more funding requested as we sort of move through the stages, the more confidence DIV will need to have the evidence base underpinning the innovation. Given that our core model is essentially testing unproven ideas and then only bringing to scale those that have proof of cost effectiveness and evidence of impact. That's something that we really care about. Okay, so moving on. The investment process. So as I mentioned, it's rolling, so you can really apply at any time. The process, I would say, on average, it takes between 8 to 12 months from application to execution, but this varies widely. So to be quite candid, given the fact that we are, housed in the U.S. government, we work extensively with the Office of Acquisition and Assistance, OAA at USAID, and so I can speak about this a little bit more, but we do experience some bottlenecks typically in executing our grants towards the end. And a lot of that is sort of outside of DIV's immediate control. So, starting with the initial assessment. So this is the expression of interest review and consensus. So this takes about 2 to 3 weeks from when an organization submits their EOI. It goes to a primary reviewer on the team, who then, if they find it promising, they kick it to a secondary reviewer also on the DIV deal team. And then those 2 reviewers will basically undergo a consensus, which is essentially just, I think of it as like a pre-investment memo. It's basically, like why we found this innovation appealing. What our evaluation criteria is beyond the 3 legs of the stool that I've already elaborated upon is, essentially having an innovative idea, and basically we don't fund prototypes, so there has to be some sort of minimally viable product or some initial customer testing that and providing some sort of customer demographics in the EOI would be is very beneficial. After that, we conduct our due diligence, which this can take anywhere from 2 to 4 months, depending on the stage. Our stage 3s, I would say, really pushes the upper bound there, but our stage 1s, we're a little bit more expedient. The decision makers here are the deal team, external reviewers, external outside of USAID, so really pulling on our researchers from development economics, the bank, etc., and then relevant USAID missions and technical bureaus. And here we're really looking at impact and financial due diligence, looking at financial models and reviewing the literature on the evidence base. The quality of the management team. So here's really where we, after the consensus stage and throughout due diligence, we are empowered essentially to speak to applicants, as frequently as we'd like. So, and that, that at minimum, that would consist of a few phone calls with the management team. And also something that we look for, and again, this especially for our stage 2s and stage 3s, are requisite institutional buy-in. So for the randomized control trials, for example, that we fund of public sector programs, making sure that there's actually a demand for the innovation, in the host government institutions. After that, so after the due diligence, assuming that we'd still like to move this to award, then it goes to the tech panel, the technical evaluation committee. This is essentially a red light, green light. So this is a formal call. I put a week, but it's essentially a call where we have with the applicant. It consists of the deal team, another DIV team member who is not involved in the deal, an external reviewer, and the chief of DIV, who is Ann Healy. And essentially, we make a deal or no deal decision based on the above criteria, and we use the call with the applicant as to answer any remaining questions. After that is the award negotiation and finalization stage. So this is about 1 to 6 months. As I mentioned, this is sort of where, unfortunately, a lot of our bottlenecks appear because we are relying on. There's a lot of back and forth with the applicant in terms of figuring out, like I mentioned, the payment milestones, so the pay-for-performance structure. Some applicants have to go through environmental reviews, which can take a few weeks, and then budget finalization. So, given the fact that it's been around for about 6 years, I'd say that we have a good working relationship with the OAA, but there are still some unanticipated challenges that we're working hard to mitigate, but that's just something to be important of, or aware of. So, red flags. So what are the top 3 reasons for deals not materializing? So this was an interesting question, and I could probably give a couple more, but the 3 that I think I see most, I see on a regular basis. So the first one is insufficient evidence of impact. So this could be something like a lack of a valid control group, or sort of not parsing out confounding effects, limited measurement potential. So for an innovation that is really not conducive to actually, monitoring or evaluating in a meaningful way. Next is limited potential for scale. So this is something like, maybe there's a great impactful product, but there's no market for it. So lack of demand, a poor regulatory environment, just given constraints of host country governments, etc. Or is cost prohibitive, just in an absolute cost sense, but also a relative cost. Just perhaps the product is achieving higher impacts than the existing product, but the existing product is far cheaper. So this will just never have any sort of market viability. And then next is an unclear rationale for div funding. So given that we do fund, for-profits and nonprofits, so we fund many social enterprises, how is div funding, how is grant funding catalytic to the organization's growth versus something like, debt or an equity arrangement? And then advice that I have for entrepreneurs to help them avoid common mistakes. So I would say in the EOI, it's short. I mean, it's really only about 5 to 8 pages. And I'd say, make sure that you clearly articulate what the specific innovation is, and your total addressable market, in very clear terms. And I think it's also very important to show that you understand the competitive landscape within the context or the country that you're working in. Next, so again, sort of get into my third point above, explain how grant funding would be catalytic to the organization's growth. And lastly, identifying clear and targeted proof points that allow, the organization applying and also external funders to track progress is key, and that would tie into the milestone payments. So the conscious time here, so I'm happy to take any additional questions in the Q&A round.
Yeah, thanks, Erin, and we'll hear from you again during the Q&A. I'm going to move now to our next speaker and introduce Charlotte Ward, who's a director at the London Foundation. Welcome, Charlotte.
Hi, Wade. How are you?
Very well, thanks. And you?
Good. Now, I've had a little bit of trouble hearing Erin, and I think it's a problem on my side. So if it gets bad the other way and you can't hear me, I will redial back in on the telephone. Okay. But hopefully we'll be okay. Okay, so yeah, I used to be with GSMA, working in the team that's become Mobile for Development Utility. So it's very exciting to be on the other side, and to be working with you in the webinar. I joined after GSMA, the Lundin Foundation, about 2.5 years ago to lead their activities in East and Southern Africa. I've been in Kenya now for about 9 years, and before that was with investment banking. So on the next slide, a bit of background about us. So we do invest in only certain sectors, and we'll invest both directly into a company as well as into pooled investment vehicles, being funds or holding companies, which focus on frontier markets. Everything is within sub-Saharan Africa. On the direct side, our sectors of focus, all of which have, mobile can play a role, are energy access, financial inclusion, agriculture, and human capital sort of businesses like talent sourcing and selection. We invest at very early stages, seed stage and onwards, to sort of early growth. But definitely sort of revenue generating, there is a proof of concept already in place. Company does not need to be profitable. We're very used to investing where the company is also receiving grant money. There's certainly a role for certain kinds of grant money for quite a while, we think, in early businesses. Our investment size and structure. So we would take minority equity stakes, quasi-equity, and also invest debt. Typically, a smallest amount is around $200,000. We can go a little bit less if it's a very early stage business, and we can see there'll be there's opportunity for follow-on investments, but there's higher risk perhaps at that point. And we go up to about $1.5 million. We like to be, what people call kind of fit for purpose capital. So our instruments will vary depending on the need of the business. And we have I think every time we have done follow-on investment as well, either in the form of future equity rounds or shareholder loans, or perhaps working with other lenders. We've been involved in working capital debt facilities. So on to a bit about our investees. A few of the logos are at the bottom there. So we have 13 direct investees, including Acre, PowerGen, Ahsoka, and Copa and Zona, who are in there, definitely in the sort of use mobile to enable themselves. And we have 8 pooled investments, including Responsibilities Energy Access Debt Fund. And we typically make 2 to 3 new investments per year, and as I said, multiple follow-on investments as well. So on to thanks. Our mission statement and impact. So we want to invest in businesses that are high achieving, have high impact. We very much believe that social impact and financial return are entirely aligned. So we want to see that, like, it's very powerful to have see responsible profit driving African development forward. As I said, where increased profits creates increased impact, and vice versa. Our return expectations, our target is between 6 to 8% a return on a risk-adjusted basis, which basically means the return is defined by how much risk has been taken. We expect some companies in our portfolio to be far above that, and others won't, so that's on a blended approach. And the duration investments, we are like a holding company. I forgot to mention at the beginning, we're a non-for-profit organization, but we don't have a fixed time period like a fund. And in terms of how we participate, we will take lead in an investment or not. It really depends on a case-by-case basis. On the next slide. Finding deals. So we find deals in a whole range of different ways, but probably the least successful is through sort of cold calls and cold emails, to be honest, although we are always searching what we get to make sure we're not missing any gems that come that way. We tend to follow up references that are provided or recommendations. Our networks are very important, so we do invest time in continuing to build them and improve them and broadening them. By that I mean either discussions with other investors, co-investors, and our current portfolio. We don't have any mandatory sort of formalized arrangements with any other investors about co-investments, but there are several who I've listed, some of them there, who we will often be discussing opportunities with if it makes sense to, or sort of passing things on or receiving things if they're not quite right for the other person. And we find networking events actually getting more and more interesting, of where you'll meet new people, and from that sort of initiate the conversations and carry that forward. I say, GSMA's events being one of them. In terms of what we look for in an organization, whether this is through initial discussion or the information we receive, we're really looking for a high-quality, committed management team. The team to us is very important, and also it could include advisors or board members if there is one at that stage. We're very, if they have presence in the market where they're operating or just set up, it is important to us, and they have experience in those markets. The second one is a clear pathway to profitability. Probably goes without saying. We've got to really believe that, from what we hear, that there is, the company understands that's where they're heading, and they may not be profitable yet. And then thirdly, we'd like to understand sort of what other financing is already in the business, or what are the financing needs going forward. And involved in that sort of financing needs is, what is that company actually looking for as an investor? And that needs to be a very, I think, open and frank conversation. What skills and sort of non-financial support do they need? it's not just a sort of a personal fit, but it's also more of a strategic and sort of the long-term partnership you're entering into. And we have to make sure that the company knows what to expect from us, and vice versa. And I think at an early stage as possible. So on the next slide, our investment process. So much like anyone else, I think, there's initial meetings in the first sort of 1 to 4 weeks. We sort of do a kind of get that first sense from people around, and one investment manager who sort of brings in the deal or has the most appropriate skills in the team to explore the opportunity at that stage. We'll be looking at the company in terms of what is so innovative about their approach to solving a problem and generating that social impact. Probably a note worth mentioning is, for us, social impact can come in various different ways, but ultimately it's increasing incomes and also generating employment. And there'll be other sector-specific impacts as well. Obviously, different ones aligned to an agribusiness, which could be increasing access to quality products and markets, versus an energy company, which is obviously increasing access to electricity for basic or productive use. We need to feel that the value proposition is really there, and there's a vision tied with that. Then we'd move that through to doing an initial due diligence and to reach a term sheet, and that is use an investment manager in the internal team, and we bring in our senior management if we need to, when and where, and that's looking at the understanding of the addressable market, the market demand, drilling down into that, the business model and the financial projections, and also having early discussions around and seeing what sort of investing instruments and financing needs are there now and over sort of midterm. We hope to get that all done within a month, and then subject to agreement of term sheets, obviously we'd move into much more in-depth due diligence on a sort of a typical process, and there the deal team's normally made up of 2 people, so at least one of them is very much on the ground in the market or very close to the market where that company is. We have teams in Nairobi, Lusaka, and Accra, so that's not normally a problem for us for Africa. And then you're looking much more into the risks and the mitigation strategies, understanding the growth drivers, and then working through legal due diligence. And we then will propose the opportunity to our investment committee. Some of those members of the committee we would have already sort of prepped in the course of that process and drawn on their expertise, and then look to close out documentation, which can often form a substantial part of the time required in the whole process. And in that, obviously, criteria around the legals are looking at the rights attached to the investment, either as a shareholder or as a lender. I'm happy to talk more about that in detail if anyone has any questions, but I'll keep going on because I'm just mindful of time. And maybe there could be conditions precedent or subsequent to the investment that we need to decide and agree upon. Red flags, top 3 reasons why deals don't materialize, I feel, is realizing there's a lack of skills or experience that's relevant in the senior management team, or that senior management team also perhaps the dynamic isn't as it should be, and we're worried about what that could look like in the future. The growth drivers, that they're not really understood properly, especially if, and this is actually probably relevant to them using mobile in terms of mobile technology, is applying that mobile technology into a new market, potentially in Africa. You really got to understand what are the non-tech elements to seeing that business grow, and that's really going to be around factors that relate to execution, obviously, and customer and sales and logistics. And thirdly would be a lack of proof of demand, and that value proposition actually just isn't as unique and exactly what the local market is looking for. Our advice to entrepreneurs to help you avoid some common mistakes that we've seen is related to the top 3, really: understanding your addressable market and value proposition very well, allowing time to develop relationships with your potential investors and the time it takes to close a deal. You're going to be in this for a while, you're a partner, so you've really got to work on that and really try and understand them and see how aligned they are with other investors. Lastly, just having the right skills suite in the team.
Thanks very much, Charlotte.
That's it from me. Thanks.
Thank you very much. Yeah, we're going to come back to you again, I'm sure, during the Q&A. Some really interesting points that you made. Just a reminder to all of our attendees that you can submit your questions using the chat box, and please direct them to staff. And I'd like to bring in very swiftly our third and final speaker, Josephine Ragney from the Netree Foundation. Hi, Josephine.
Hi. Thank you very much for inviting me, and it has been very interesting for me to listen to the other speakers as well. So just jumping straight in, I would like to talk a little bit about the model of Netree. I'm the social investment manager, and the Netree Foundation is a private Spanish foundation. We're based in Barcelona, and it was set up 11 years ago, and its mission is to alleviate extreme poverty and income inequality. And on the left-hand side of the slide, you can see a little diagram which shows our model, and the founding family provided an endowment which is used for investments in social enterprises, and there are two, let's say, buckets. One is social investments in microfinance, and the other is social investments in other sectors. And the sectors we look at are rural development, access to energy, health, education, and access to finance. And we basically funnel all the returns that we get from these social investments into grants that, support development projects that will never be financially sustainable. So, with this model, what we try to do is have a sustainable model for the endowment and produce social impact both on the investment side and on the grants. So looking at the background slide, I mentioned the sectors we look at, and I'm focusing very much on the social investments in other sectors at the moment. Typically, we focus on social ventures which benefit people who live on less than $4 a day. So in terms of geography, we focus very much on sub-Saharan Africa and Southeast Asia, and some pockets in Latin America, some more marginalized communities therein. In terms of our investment structure and size, we do predominantly debt investments, and the reason for that is that debt allows us to basically predict our cash flows so that we can also plan for our grant giving. So we normally, about 90% of our portfolio is in debts and loans. And looking at the stage of the companies we focus on, they have to be a little bit more mature. They have to be able to support debt on their balance sheets. And we also invest in non-profits, so just as long as they have a certain cash flow that can support debt, we are fine with that. So normally we also look for at least 2 years of operating history. The investees that we have at the moment, we have around 15 investees in the other sectors area. I've provided the logos for some of the companies we've invested in. For instance, Sproxel, D-Light, and Incopa are all companies where mobile-enabled technology is either core or very important to their business models. Moving on to the investment mandate, I suppose what I'd like to just concentrate on here is looking at our return expectation. Impact is most important for us, so we are happy to accept below market returns. And we often actually work with other investors that often have to meet certain minimum criteria for investment returns. And we're happy, for instance, to participate and co-invest with these investors where we accept a lower rate of return. And But however, we normally enable their investors the investment. So we feel, we are providing quite a catalytic role, allowing our investees to get more financing as a result of our below market returns. In terms of the duration of the investments, we're not bound by any time limits. We are a foundation, not a fund. So typically our debt investments span from 2 to 5 years, and equity investments 10 years or more. We are a very small foundation in terms of looking at the next slide, finding deals. And it's just myself, the founder, and as a result, we have to work with a lot of external advisors and co-investors. We do have formal agreements with, for instance, the Deutsche Social Finance Group, LGTVP and Alpha Mundi, where we have co-investment agreements. We also work with other foundations in terms of looking for co-investment opportunities. And we find conferences and forums also helpful to meet new companies, Sunkelp, Skoll, and in the past, I've been very fortunate to be able to go to the GSMA Mobile conference in Barcelona, and I've met quite a few of our investees there as well. Looking at the 3 things to look for in organizations, for us, social mission has to be very well aligned. So any investee that we look at, has to have as a core interest furthering its social mission, and it has to be able to also measure this impact. So as long as they are very focused on the social impact they generate and are able to measure that, that's the first step for us. And again, management team, a capable and very importantly transparent team that communicate effectively is something that we really look for. And as we focused on debt investments, we really also need to secure that they have an adequate capital structure. And what do I mean by that? That they either have sufficient equity, or they have grant funding or cash flow generation to allow them to service their debt. So that's something that we focus on quite a lot in the investment process. I don't want to dwell on this very much. We follow quite a traditional, let's say, process of initial screening, the due diligence, and then coming up with the term sheet, and then getting into the legal due diligence. The only point I'd like to make here is that it takes time. Even if we're a small organization, typically, it takes at least about, I would say, 6 months from the initial conversation to the closing of the deal. So for investees, it's very important, I think, to plan way in advance, what type of financing needs you have, and to be very proactive in looking for financing. And then moving on to red flags. I would say the top reasons for deals not materializing is when information flow is not fluid. So, we need to have sufficient financial and impact analysis to present a case. And sometimes it's just very difficult to gather that information. So, if investees have a good pack of, let's say, information that is really helpful for us. Another area of deals failing is when maybe the financial analysis does not support the type of investment proposed. For instance, we might have a company asking for debt, but they might not have the right capital structure or sufficient equity cushion. So often we will negotiate, for instance, with the company saying that they need to have a precondition of a certain amount of equity before you can apply for debt. And then I suppose another area is looking at, we identify risks, and if some of these risks can't be mitigated, then it's very difficult to approve this deal. And risks can be multiple currency management, all sorts of risks. In terms of advice to entrepreneurs, I think one area is really work hard to position your case. The more clearly you can articulate your vision and strategy, I think the more success you will have in attracting partners that are right for you. And then another area I think is be very proactive in seeking expert help. What do I mean by this? Typically your business models are very new, very nascent, so the more you can make use of technical expertise, technical assistance funds, grant funding to pilot ideas and really test your business models or your products, then I think that the more foolproof your business strategy will be when you commercialize it. So really try and find out what resources are available for you and make full use of that. And then the third area I would say is really build relationships, and the value of a really good board, for instance, and having good leadership. So many investors really look for a good corporate governance structure. So the more you can surround yourself by expert board members and good leadership, the more likely your enterprise will be very positively seen. So that's my.
Thanks very much, Josephina. Thank you very much for that. Very insightful. And we're now going to move into a time for Q&A. And I think even from the different presentations that we've had, some common themes there, talking about teams and the importance of having a good team, and all the different investors that we have here also kind of touched on mobile and that technology. So we're going to come on to some of those questions. Just to lead off with, the first question that I'd like to raise, and I'd like to maybe, if I stay with Josephine on this first question, and then we can hear from Charlotte and then Erin, would be, you spoke about mobile in your portfolio. I wanted to just understand how does mobile technology, does it excite you when you have a business that uses mobile technology, and what impact does that have on your investment decision process? And maybe speak to us about some of the benefits that you see and also some of the risks.
Absolutely. Well, we invest in many sectors, and technology can be a fantastic tool to make a business model viable. For instance, the whole pay-as-you-go, rent-to-own business model in the solar access space has really changed the environment. Many years ago, before this pay-go mobile-enabled systems were available, solar products were just not affordable, and therefore the companies could not get enough demand for their products, and therefore they could not produce in volume the products and make it commercially viable. So I think some business models that have come up are incredibly exciting, and we definitely feel that mobile enabled technology has been the reason for that. Another company we look at, obviously the solar space is very well known, but there's other innovations that we find quite interesting. For instance, we invested in Sproxil, which is a company that uses mobile technology to authenticate products. So they devised a system where they can identify counterfeit medication with the use of mobile technology. So, we are very excited when we see that there are companies with breakthrough technological mobile applications, and they can execute that well.
Thanks very much, Josephine, for sharing that excitement. I wonder whether Charlotte, whether you also sharing that excitement. Maybe
Yeah,
speak to
definitely.
some of the benefits and some risks that you see.
Yeah, I mean, you can see by some of the names in our portfolio that I would echo certainly Josephine's comments around the impact of mobile enabling access to off-grid power. So that accessibility to services, I think, through micropayments is made a lot of these products scalable and more affordable to actually run. Also, the power of it for monitoring, the power of mobile for people to access curated information are all brilliant. They've been game changing, I feel. But alongside that does come many risks, as you've pointed out. So I think in summary, what we find is we're looking at a company that uses mobile in such ways is that we realize the importance of the technology to achieving profitability, but making sure that doesn't overweigh the actual importance of execution, as Josephine said at the end, because otherwise that almost becomes more of a risk. And that goes down largely, can filter down to if you get a team, people have a company that's very mobile enabled, and the team is all made up of perhaps business experience and technology experience, but there's no operational or logistical experience, no one there who understands customer-centric design and delivery, then that's a red flag to me. And in all of our companies that are using mobile, we've seen great success and encouragement when the senior team sort of start to almost spend less time worrying about the technology, finding the right partners to help them, and then focusing on customer, putting the customer first, figuring out the distribution, the logistics, building the service that's required to make their business a success, and really understanding who their end consumer is. So that would be my comments, Wade.
Yeah, thanks very much, Charlotte, and thanks for touching on some of the risks there as well. Very important to sort of know them. I just want to turn to Erin, who I know was in somewhat slightly different sectors. So could you kind of give us your take and your view?
Sure. I can make this quick too, just so we can. I think that Josephine and Charlotte have sort of highlighted a lot of sort of what we're excited about and concerned about as well in terms of the risks. One thing that I will say, that I will add, given that, like I said, that we do fund a lot of research in the space as well, is the room for mobile data collection. It's something that we're particularly excited about and something that I see as a huge value add when I'm reviewing, when I'm sort of conducting due diligence and working on selections. Just with the being able to sort of automate and use platforms like Survey CTO, et cetera, or something similar to like a Demogi ComCare platform, and being able to sort of collect customer data, whether it be impact data or health data, whatever it is. And being able to essentially use that data in real time to make management decisions is something that I think is very appealing, both from a cost standpoint and just from an efficiency standpoint as well. So, and in terms of our portfolio, I mean, beyond just the research question, I mean, as we've touched on already, the pay-go services, but so for the majority of our off-grid portfolio, that's typically embedded, And then we're starting to see sort of mobile being applied to sort of non-traditional sectors as well. So one interesting organization, Good World Solutions, that is in our portfolio is essentially their theory of change is that direct connection via mobile will improve workers' economic livelihoods and financial security. So essentially what they do is there's a platform in which workers in various working for in Bangladesh are essentially receiving information about their rights and available services via what's called Labor Link, and they're able to report on their working and living conditions to decision makers, which increases the visibility sort of in the real-time data and changes business practices. So that's just an interesting application that's obviously different from the off-grid and energy and wash space, but I think just highlights sort of the trajectory that mobile is on and applying to sort of non-traditional sectors.
Thanks very much for kind of giving that perspective as well of the non-traditional sectors. Very interesting responses there. I'm just conscious of the time that we have. I want to have a go at trying to get through maybe two more questions, and I'll ask that our speakers maybe keep their responses to some bullet points. I want to go to one question raised here from one of the attendees, which is all three speakers mentioned the quality of the management team at the company that they're evaluating and as an important criteria that they look at. And so the question here is, what is it specifically that you look at? Is it brand names in the CV, number of relevant years of work, fit with some other internal criteria that you have? So could you touch on that? And the question here is it purely qualitative evaluation, or is there some criteria that is quantitative? Maybe we could start again with Josephine.
Right. Quality of management. Charlotte, I don't know if you wanted to say something. So just coming back, I think there are so many facets of quality of management. One is obviously harnessing, whatever product or service they have is executing well, and building the right team. Often, one thing we do find sometimes in companies, social entrepreneurs find it quite hard to delegate and find it quite hard to decide what is going to be best for the company, because they're just so busy themselves that they can't think often very long term. So I think that the earlier you build expertise within the company and really build also a good corporate governance structure, really expert board members, the more direction you can get. Another area is really understanding your competitive landscape, and not being afraid to change strategy. Again, I mentioned it, but most of these business models are so nascent, and it's often trial and error. So the more information you can gather, study it, and make important strategic changes when necessary, I think that's also a very important skill set. And then I think another area is transparency. We have come across management where they are concerned about talking about failure. And again, I think as long as the communication is good, investors can be very understanding and work with the management to deal with challenges.
So thanks for that, Josephine. You gave us kind of 3 points there. I maybe want to just quickly turn to Erin and Charlotte. Maybe Erin first, just to see if you can just give me maybe one more additional point, whether you agree, and then Charlotte.
Sure. Just to highlight one in particular, I think that the experience that sort of in-country experience is critical, especially since, like I mentioned earlier, a lot of, if we're both our research and operations-focused grants, the quality of the work is really going to depend on the regulatory environment and the state of the MOUs being signed with relevant government ministries, etc. So seeing that a management team or some aspect of the team has a lot of in-country experience, whether it be in specific sectors, etc., just being able to know that landscape well and navigate it, I think, navigate it efficiently is, I think, critical.
Thanks, Erin. I'm going to move to another question just because of time, because I really want to try and squeeze another one in. Just looking at the list here. One of the questions submitted during registration was, can you give us your view on the trade-off between financial returns and social impact in your investment decisions? And since I'm with you, Erin, maybe you can take the first go on that, and then I'll turn to the other speakers.
Sure. So, I mean, I think that that's a great question, and something that I don't think that we're super prescriptive on. But I will say, I mean, we certainly prioritize the social impacts of the financial return, especially since we don't, we're giving grant funding, so a lot of what we're doing is aiming to sort of de-risk future investment for grantees. So I would say that we don't necessarily have a hard and fast rule there, but I would just say that prioritizing the sort of, showing the sort of viability of your model in terms of achieving the social impact sort of laid out in your theory of change, but also being able to sort of, test the financial viability. We don't anticipate, especially for earlier stage grantees, that they will have, they'll have the pathway to scale or the financial viability up portion mapped out. But given that our fundamental focus as DIV is sort of a VC fund for organizations targeting BOP customers, we do really prioritize the social impact piece.
Okay. Thanks, Erin. Maybe I'll turn to Josephine. I think we've lost Charlotte. I'm not sure if Charlotte's still on.
No, I'm still on, actually.
Okay. So maybe before Josephine, maybe we can hear from you, Charlotte, and then Josephine, and then that will probably be the last set of questions for today.
I think assuming you can hear me, I'll keep talking. So I just want to add one more comment, though, in terms of what's a quality team. You asked sort of, is it quantitative, qualitative? Another factor to add on, just really briefly, is the personality of the people in that founding or kind of senior team. Are they going to be bootstrapped? Are they going to be able to make decisions quickly? And also, have they got the sort of the stamina as well? I think that's something that you can't get from a CV. You get that from meeting and spending time with the people. But just going on to terms of social versus financial return, in our mind, ideally, it's all aligned. If a company can grow and scale through having sustainable model and becoming profitable with growth, then you're going to have more social impact by virtue of who the customer is and what product and service you're providing. So in our minds, they're entirely together, and we don't want to sacrifice one for the other.
Thanks very much, Charlotte, and very swiftly to Josephine to close out the round of the questions.
So on the social impact and the return factor, I think that in some companies, the financial return is completely directly proportional to, let's say, the amount of social impact you're having. So, for instance, if you're distributing a certain medication, the greater the scale, obviously, the more social impact you're going to get. Whereas in some companies, for instance, maybe a company that is buying products from smallholder farmers, there you can have a conflict of interest because the company could make more money if they let's say, get an inferior price for the product. So just depending on what type of company it is and how the social impact is derived, we do differentiate a little bit. For instance, where there could be a conflict of interest, we make a point of, making sure that management social impact, let's say, goals are the same as ours.
Thanks very much, Josephine, and to all of our speakers, really. We have used up all of our time for today's webinar, even exceeded it, and I want to thank everyone who stayed on. We're definitely going to have to follow up with the questions that we weren't able to cover, a number that was submitted live and some during the registration process. We will follow up with those questions with all of the people who submitted them. And if you weren't able to get your questions in during the live webinar, you can send your questions in to the email address there at the first one in the bottom corner if you have any further questions. And specifically for those directed to any of the speakers, and we'll kind of facilitate that. Also, I mentioned the Innovation Fund earlier. If you had any specific questions about that, then you can send those queries into the second email address there that you see in the corner. We don't have a call open right now, but we will be having one in 2017. I do hope that you found this webinar insightful, and we're very keen to hear your feedback, so please do write to us. Today's recording will be available on our website in the coming days at gsma.com/mobile for development, and you can find all of our resources on the website. All of you as attendees will receive a survey, and we would appreciate if you could send us your responses. And do remember that there are 2 more parts to this series to come. The next webinar will be on the 13th of October, and we'll be talking about impact funds. So please do register, as registration is now open. Lastly, my thanks to our speakers, Erin, Charlotte, and Josephine, and to all of our attendees for taking the time to join us for the webinar today. Do enjoy the rest of your day.